Hi everyone, this is Sunny Sublok from Matrix Law, and today I'm going to speak about the DVR share, a very important instrument which is used by founders and companies when they want to structure their investments into their company, or as and when they're receiving funds from an investor into their company. It is a very important instrument, and this is going to be the topic of discussion today. In the meantime, if you have not subscribed to my channel, I would suggest to go ahead and subscribe. Also press the bell notification so that you get an intimation as and when we post videos. If you have any comments on the video, then obviously I would request you to please put down your comments in the video itself, and I'll be more than happy to answer each and every query that is put up. To proceed to the topic of discussion today, which is the DVR share. As you're aware about the fact that when an investor is investing in a company, he generally is issued certain instruments in return for the share application money that he puts into the company. Now, typically what happens is that the investor would invest in the form of a compulsorily convertible preference share. What that only means is that it is a preference share till the time it is not converted into equity. And the reason why the investor does that is because he wants to have a preference in terms of the dividend that would be payable, and also in terms of return of capital if there is all a need for the company to return the capital back to the company. So in that sense, a CCPS has been typically used by investors in the past, but I don't know, I've been seeing this very recently, and I have no reason why a DVR share has not been used by founders and by companies. So let us move into this, and let me try and explain to you the benefits that a DVR share has over other instruments which has been traditionally used by companies and founders in the past. So under the Companies Act, equity shares can be of two kinds. One is an equity share with normal voting rights, and the second type of an equity share is called a differential voting right share, which is also famously known as the DVR share. A DVR share only means that you can issue shares to an investor in such a way that you can have a difference in terms of the voting rights, and also it could also be structured in such a way that there could be difference in terms of the dividends that could be paid. So let's see practically what happens and what is the expectations of both the parties generally in an investment transaction. Typically, an investor is not interested in controlling the company. All he wants is a higher dividend because he wants a higher rate of return as and when he exits the company. And what is more important from a founder's perspective is to make sure that he does not want to get diluted beyond a point where he does not have any control in the company. As and when an investor typically invests in a company, the founder gets diluted. And what typically happens with the dilution is that you tend to lose your rights and therefore control in a company. So therefore, a DVR share is a win-win situation for both the investor and both for the founder, where a founder gets to exercise control over his company even when he gets diluted, and at the same time the investor is not interested in controlling the company, and he gets a higher dividend as and when the company either declares profits, or as and when there is a liquidation event at the company, or the company is consolidated. So it is a practical win-win situation for both, and I think DVR shares are going to be the way going forward. And if you are a founder and if you're already looking at raising funds, then I think you should also seriously explore this option, which is a very simple, straightforward procedure to be followed under the Companies Act. In the economies all across the world, even if you have a look at what's happened in the US and you look at most of the big tech companies, the Alibabas, the Googles, and the Facebooks have used a DVR dual share structure in the past, and it works beautifully for the founders. And at the same time, it is equally rewarding to the investor as well. So the benefits of this structure are absolutely great. Now we will discuss about what are the procedures that have to be followed under the Companies Act in order for these DVR shares to be issued to the investors. So certain terms and conditions have to be followed or have to be adhered to under the Companies Act before you issue these DVR shares. Mind you, we are talking about the DVR shares here purely from the issuance from a private company's perspective. Obviously, there are other terms and conditions also to be followed if you're a public limited company, but in this particular video, I'm basically focusing on private limited companies because I believe most of the investments that most of the founders are seeking today are for investments into private limited companies. So coming back to the terms and conditions which have to be followed under the Companies Act, and they are very simple and they're very straightforward, and they're basically related to any major non-compliances that have been done by the company in the past few years. So unless you have a huge non-compliance list or a non-compliance issue from your own end, going ahead and issuing these DVR shares is a very simple and a straightforward procedure under the Companies Act. So some of the non-compliances which the ROC takes very seriously is if you have not filed the annual returns, or if you have not declared dividends, if you have not paid your creditors, if there are any non-compliances that are pending with the registrar of companies, or any other major non-compliance under the SEBI takeover or any other particular code. So basically, if it is connected to the non-compliances under the Companies Act, and if there are no non-compliances from your end, then going ahead and issuing these DVR shares is not difficult at all. Mind you, there is a limit under the Companies Act with regard to the issuance of such DVR shares, and they should not exceed 74% of the voting rights of a company based on the share capital. So I guess that is more than enough as and when you have to issue these DVR shares to an investor. I mean, obviously there are some internal requirements that need to be fulfilled based on your MOA and the AOA of the company. There has to be a requirement or a right that has been granted in order to issue such DVR shares. All you then need to do is hold a board meeting of the directors, get their nod and approval, and thereafter seek the approval of the shareholders, which is a very standard procedure under the Companies Act. But pursuant to all of these compliances and other internal requirements completed, these DVR shares can be issued to the investor. I hope you found this video helpful. If you have, I would suggest that you like the video, and if you have not yet subscribed to my YouTube channel, then I would suggest that you go ahead and subscribe as well, and don't forget to press the bell notification so that you get an intimation every time I upload a new video on YouTube. This would keep everybody well informed and well updated about what's happening in the startup community. If you want to reach out to me directly, you can write to me at sunny@matrixlaw.in, and I'll be more than happy to answer any query that you have, or if there's anything that I can do for you, I'll be more than happy to do so. Alternatively, you can also schedule an appointment or book a consultation with me. The link to that is provided in the video description below. Just click that link and it's completely automated. You can choose a date and time, and you can schedule an appointment, and I'll be more than happy to speak to you. Again, thanks a lot, and I will be back with another meaningful video shortly. In the meantime, bye-bye, take care.